Hi, my name is Elizabeth Cross-Nickel, and I'm one of the co-founders of Apis Health Angels, which is focused on improving the ecosystem for health startups by developing health investors who are probably taking their first or maybe their first in healthcare investment. And our focus is to make you more educated and stronger on some of the complexities that may be more unique in the healthcare space. It certainly is an industry that has a lot of excitement this last couple of years as things have come to the forefront with COVID, but there's really been an increase in life sciences activity startups coming along. So we're just glad to be supporting that ecosystem. Now I'd like to actually introduce our guest speaker. Dave, I see you've been writing notes, so you probably have done the same thing I do. So we've got about half investors and half companies. Did you get the same numbers?
Yes, that's exactly what I was doing. With that, presentation's over. Everyone have a great night. Thank you.
I am going to let Dave introduce himself because he'll do a better job than I will. But I think that the folks who have come from Boston to talk about Dave will actually say, if you listen to his talk, he's very sharp and very good at asking pointed questions. And so what we're going to try and do is to ask him some pointed questions too, by having them go into the chat so we can actually hold them until he gets through his talk. And then we'll be, in case they're already addressed as they come along. And if it's something that looks like it's really pertinent before we move on, then I'll interrupt and bring Dave up to speed. In the interim, if you want to be found, you can put your names in the LinkedIn. And if you, you can put your LinkedIn profile in the chat box. And we'll turn it to you, Dave. So we're going to have a presentation and then we'll have some open questions towards the end.
Super. All right. So everyone's face is going to get small right about now, right? I guess.
Yeah.
So I can successfully. And let's just do a quick check-in. Everyone can see the screen.
We can. Thank you.
Thanks. So I think Elizabeth has power of attorney, it sounds like. All right, so normally, just real briefly, I suppose I have to introduce myself. So, but my intent with this is at I guess at a high level, right? Trying to, just like the Golden Gate, bridge the gap between value and investment. And for the folks from Baltimore, Ignacio and Joshua have seen bits of this or a good majority of this before. As this is a talk I've given, it also is part of an educational training we'll do at Rocky's Venture Club as part of our Hyper Accelerator breakout on valuations, where we'd actually walk through some of the tools, right? So there is no way in heck I expect you guys to be facile in any of the tools. My goal here is to, I guess, exhaust you and then receive the pointed questions that Elizabeth threatened me with at the Q&A. So since I have you all at a disadvantage, I suppose I should drop into the slides. So this looks a whole heck of a lot like me, except I looked this way early in the week when I was judging an innovation panel, because I literally looked like that, and that was the picture they threw up. So I was like the gal with the prom dress that saw somebody else with their prom dress, right? I was like, oh, look exactly like that photo. So this is the way to get a hold of me, phone or email or by LinkedIn. My bona fides, I suppose, you can hear the Hopkins DNA coming out from some of the audience, but I was an undergrad and a graduate student at Hopkins, biomedical engineer. I was actually supposed to be a professor at some point in my life. I decided to then go into med device, where I have an increasing pathway in Sorin Biomedica, Tyco Healthcare, which then became Covidien as part of, at that time, the world's largest spin out of a medical device company. I was then acquired at Covidien by Medtronic, which was the world's largest acquisition. So for a Livongo Teladoc person, I feel you a little bit from just a little bit of a different perspective. After Medtronic, I decided to say what the world looks like a little bit differently. And so I turned to the startup world, where I joined as Rocky's Venture Club. A little bit of a blurb from Rocky's Venture Club. Longest running angel organization in the US, by the way. We early 80s out in Colorado. We have about 225 members, and we do about let's say 15 to 17 investments a year, 15 to 20, I suppose, and an average investment size of about, let's say, 125 to about 375. That's a bad way of describing average. And I just want to do a quick check-in, Elizabeth. My screen flashed. I want to make sure everybody's still seeing.
Yeah, it went
It went dark.
horizontal and then came right back. So it's just fine.
Okay. All right. So super. So Rockies Venture Club, I'm on the life science committee there, kind of lead the group there. TEDCO is a Maryland state activity in terms of innovation. I got to meet Michelle initially as a VentureWell Aspire mentor, and then I do some innovation stuff with CU and CSU. I am the chief operating officer of C-Star Medical, which is a startup med device company. I could talk to you a little bit about immunology if you want a little bit later. And then I'm on the board of Spinal Line, which is an investment that Rockies Venture Club made, and I was the lead investor, and I'm on the board there. And to tie it back to Joshua and I guess Ignacio, that's a startup out of Hopkins. So that's a brief, any sort of reason to believe in what I'm about to say. I had Elizabeth take a pulse for me a little bit, and I apologize, I'm kind of managing the photos because they're bouncing on my screen. So I said, hey, Elizabeth, give me a little bit of sense of what the questions coming from the group would be. And while some of them are questions, I got a whole lot of opinion too. So it was kind of interesting to try and digest that. But this is kind of what I was hearing from you guys, and just hold me accountable to answering most of these, probably not all of them. But you know, how valuations are determined, dilution and valuation, who determines valuation, what is the expected increase in valuation between rounds, staff equity, option pool effect valuation. Probably not going to get into the weeds on that one. That's more of a cap table discussion. What is a down round and why is it bad? How does pre-money valuation change? Do valuations change for different types? In your experience, how much will a founder have after 3 to 5 rounds? And so that's kind of what the tone and tenor coming from you guys were. And yes, I should warn you, because you're not interrupting me with Q&A, which is Elizabeth and Joshua and Ignacio know that's my preferred MO. I will get to be a passionate Northeasterner, which is where I grew up. And even though I've lived in Colorado for 30 years, I will get to going because I will just be like that freight train. So I will try and scale it back, but if I will get energized, maybe Elizabeth, you slow me down and hold me to a west of the Rocky Mountains ethos. So I don't drive everyone nuts, but this stuff is kind of interesting to me, and it's really fun to talk about. So objectives, just generally a kind of a founder framework. So I'm really glad it was 50-50, Elizabeth. I think for you that have made investments, I may bore you just a little bit, but I'm trying to give equal time. Learn multiple valuation methodologies, and that's learn valuation methodologies like you learn Europe when you're in a different city every day on a 7-day trip. So I'm not expecting you to be an expert in Paris. I'm expecting you to know that Paris is in France. To the end, thank you, Caitlin, for smiling. I was like, how bad of a joke was that? Develop defensible valuation models to use in your negotiation, identify tools and resources. And I do have a section on understanding pre-money. In the appendix, I have understanding investment structure. I think Elizabeth will hold me accountable to this. I think you guys had a deal term discussion or term sheet discussion prior to this, and that's way more useful than I would be. And then develop a resource list for further exploration. The vast majority of the content I share with you today, if it's not mine, I'll show you right on the slide where I stole it from, so you can take credit. A lot of it's coming from the Angel Capital Association. So to Elizabeth's blurb early on, if you're an investor, make use of your ACA resources, because you probably remember there. And founders, by the way, you can join ACA as well. So take use of all the education that exists. So this is just kind of my model on the startup world, right? And it's really this cycle, which is, if I just pick kind of 11 o'clock on the clock, you execute some plans, right? You have these plans for your business. George has this startup idea. You achieve some milestones. In that process, you are retiring risk. The very act of retiring risk should increase your value, which should attract capital and allow you to execute some more plans. So guess what? So you can achieve more milestones, retire risk, and increase your value, right? That is, for those 50% of you that are on the hamster wheel of being a founder or a CEO, that is your life. It's no more complicated than that. I don't understand why you find it to be so hard, right? But that really is it, right? That's really, at the end of the day, what you have to do. And so I want to give you a framework. So yeah, these are picture frames. I know it really stands out in a flat presentation. So here's a little bit of framework, again, intended more for the founder view. And let's see, when should you approach an angel group? Your product is developed or near completion. And let me pause here a couple things, right? Just maybe I gave you the rate of speech user manual. You probably saw from my bona fides that I'm a healthcare guy, I'm a life sciences guy, I'm a med tech guy. So I will tend to honestly have those blinders on. I can't help it. I spent way too long in that space. Having said that, my investment portfolio is pretty distributed. I have green tech in there, I have pure tech. So there are the things. I say that all to say, this is going to have a little bit of a life science tone and tenor, which should be great for this group. But for example, your product is developed or near completion. If you're in the life sciences and that's the first time you're approaching an angel group, that's probably a little late. But if you're in software as a service, that's probably at the right time, right? So all this to say is that it's hard to cut across all the verticals that early stage investors invest in to give you what a golden set of rules are, right? You always have to think about the vertical you're serving when you look at these things. You have existing customers or potential customers. Well, again, that's not happening if you're in the life sciences. I'm ecstatic in the life sciences or in the med tech if someone's talked to Michelle and they've had their pre-sub meeting and they actually know where Michelle Lott for the RA folks on the call, and they've had their pre-sub meeting and they actually know what their regulatory path is, right? That's probably more realistic. And I'll even bring that up, and Michelle will get a kick out of this. I was judging the innovation panel, as I was telling you guys, and the one that actually wound up winning, they are actually doing a gel for wound healing. So I know someone else on this call is a little bit of a wound healing technology. And they were starting to make some claims, Michelle, cover your ears, that to me sounds like it's getting on to the immunosuppression side as to how they work as they interact with neutrophils and monocytes. And I'm like, so have you guys had your pre-sub meeting yet? Because all of a sudden your claims that maybe your 510K pathway maybe is not what you think it is, right? So now for me as an investor thinking about risk, that was like the only question I really cared about as soon as they went there. You've invested your own dollars, you can demonstrate your business plan is in top shape. That last one there, just think about this, right? You're always going to have to educate your investors, even when you are the life science person pitching to life science investors, right? Because you're going to be pitching to me and Elizabeth, and I'm going to come at it from a med device perspective in these states. And guess what? You're going to be a small molecule oncogenic thing, and you're still going to have to educate me, right? So, and the way you educate people is your business plan, right? You're going to tell them what the disease state is, what the market size is, how you're going to make money. Let's see. Highlighting some things, because 16 startups you must know and prepare for, form a Delaware C Corp. Right now, I say that and I stress that. Of course, in my portfolio, I've invested in an LLC. For those of you interested in the risks of investing in LLCs, I would have you look at the Central Texas Angel Network. They have a lot of information on their website on LLCs. The reason why we invested in an LLC is that if you can achieve a pre-revenue exit, an LLC allows the acquirer, so this is not an IPO game, right? This would be a strategic acquisition, but an LLC allows that strategic acquirer to actually get a tax advantage deal. So now, when I said, what is your strategy, right? Have your plan. You could articulate, if you're an LLC, and this is why you think you'll get an early stage or pre-revenue exit, that you actually are more attractive to a strategic. If you have revenue, that C Corp, you're going to wish you had your revenue. Decide how you raise funds, right? How much of your fundraising will be non-dilutive SBIR dollars, right? And taking you to what stage? When do you want to cross that chasm to dilutive? Determine your valuation and cap table, and then plan for your exit. I mean, those would be the highlights. And I think, I do tend to harp on this for the founders, thinking with the end in mind, right? And I think if you look at the investor commentary I got, is if you think about how are you going to create value for your investors, that's forcing you to think about, like, what's the market you're serving and what has happened in the market in terms of exits, right? So just that level of end. All right, I need to play with my pictures of you guys, because wherever I put your faces as I'm trying to gauge things, it's over what I want to highlight. So this has been, I'm going to have like carpal tunnel by moving the pictures all over. But that's really the point of this slide, is to just show all the non-dilutive ways. How do you raise capital without selling ownership, right? There's a whole bunch of ways to do that. However, dilutive ownership of the company's exchange for capital, shares of the company are sold to raise capital. It's in a sense, as John and I were fencing, it's kind of straightforward, right? Now, the legal armamentarium around that maybe is a little bit more complicated, but those are kind of your choices, and that's up to you as a founder, right? What is your approach, and how does that tie to your plan, and also how does it tie to your capital needs? Elizabeth, how are we doing on questions since I've been at it a little bit?
You're good. You're okay.
Okay. You'll pull the stop the train.
I'm stopping the train. We've got some LinkedIn connections, some resources, but no questions.
All right. I would have put coming up on a slide, you'll see a picture. So disclaimer, right? I am not giving you a 409A valuation of your company. That is not the intent of this. You'll not get a definitive exact valuation of your company, right? You will not get a comprehensive hands-on experience with all valuation methods. When we do that at Rockies as part of our Hyper Accelerator, that's 4 hours. You don't have time for me to sit down and look at your Excel spreadsheet and see how Joshua your cap table looks, right? We just don't have that time. Again, this is the tour of Europe, going through all the major cities. This is the tour of the coastal cities in Australia, that type of cover the ground. But you can see the reference to look at some of these, the 409 valuation. Because if you want to go IPO, or you're going to get some professional money, you're going to need to have that done. And I'm going to pass through that just for the sake of time. So this is my cue to remind you guys, no, this wasn't deliberate that it's reds and oranges like my paint or my shirt, but this is really, I want to kind of give you some stuff in broad strokes, and to give you a little bit of this, of kind of valuation at a higher level before we drop into kind of more of the rudimentary, how do you calculate it? So everything is value. Do you guys all buy that? Does that make sense? I do live in Boulder, so this is probably just a beginning of all the wheat bread choices I have, right? This is probably just a section, and it's not from actually maybe from Whole Foods, but who knows? But what strikes you about this? All right, Elizabeth, I'm going to put you in the spot. What strikes you about this?
Well, they're all different ingredients, different packaging, but someone's going to buy them. I might not.
Well, and Elizabeth is teeing up on right, which is shoot, they're all wheat bread, right? Ostensibly, they're all wheat bread. They all have a value there, but they're a whole lot of different prices for that wheat bread, isn't it? Mm-hmm. There's one that's $3.99. You can get two for $3.50. There's in the upper right-hand corner, $4.29. Yeah, $3.99, that bottom row, right? So it's not hard. If you can have value wheat bread and have all those values of wheat bread, sure as heck I can come in and value Caitlin's company, right? I mean, that's just kind of the way the world works. We do it all the time, right? We make value-based decisions all the time as people, right? We take a direct flight. We take a flight that connects. We're trying to gauge how much do we want to spend and what value do we get from that decision, right? That's at its heart, that's all valuation is. It gets more complicated from there. But it's hard because it's like, you just don't go out and run a marathon, right? Dave Jiraco doesn't decide tomorrow, hey, I've got some time on my hands. Let me fly out to Boston a week ago and run the Boston Marathon, right? You actually train and you do some runs. So trying to figure out what your valuation is, it's better to do it sooner, right? And try some things on and figure out which are the best ways for you to articulate the value of your company. Okay.
David, along those lines, it strikes me that there's the sale pricing to kind of drive action, right? So you've got the big tags for the sale prices that may from one day or another change. So even the volatility of pricing and how you're trying to drive consumer behavior stands out.
Well, Caitlin, that's fantastic. And at the risk of, let me seize the moment since Caitlin raised something I have a little bit further on. So there's a little slide where we'll talk about kind of this meeting of the minds of valuation. This is actually a true story from RVC, and it was with Cirrus MD. So it's a real company. You can actually go look it up. And Rockies came up with a valuation. I'm going to be notionally right because I'm not looking at the number right now, but let's say it was $4.5 million, right? That was the valuation. And Elizabeth knows this. Everyone on kind of the 50% that's on the investing side says, okay, that's great. So now we've got to actually herd all the cats, right? And raise the money we want to insert for that valuation, right? There is, all right, well, $4.5 million, let's say we're investing 5. So the pre-money would have been 4. The post-money would be 4.5 in that valuation. So now we're going to raise $500,000, let's say. So now I've got to incent, to Caitlin's point, I've got to incent people to go put their money in. Actually, the founder came back in and made it a little bit less of a valuation so that the company, so that the investors at that moment were getting more of the company, because he wanted to get the money sooner. He wanted to close around quick so he can go out and run some pilots quicker, right? So this is a little bit, and Caitlin was describing it from a different perspective, kind of, you can't take your valuation out of that moment in time and the dynamics that exist. So just keep that in mind a little bit. The other thing I like to talk about, I don't show it here, is, right, it's real estate. My house is right next to somebody else's house, and we're going to have varying different prices, right? Because there's multiple factors. So if you can value houses, and maybe it's a square footage thing, you'll see some of these tools here. So let me move us on. Sorry, guys, I'm glancing at the clock because I think I have about 6 or 7 hours with the team, right, Elizabeth? So I can run to about 1 in the morning my time.
Yeah, no.
Okay.
You
Okay.
have, we're going to go until about 6:30, stopping you and making sure the last half hour is questions.
No, so no worries. So I'm going to skip through this. We talked a little bit about it, and guys, you see how easy it is to make Elizabeth have a heart attack. So just
No.
file that away. So price is not equal to value, right? That's kind of what we've been building up to. Just think about that for a second. So price is not the same as value. So uses for valuation, kind of useful thing to know, right? Determine the percentage of an equity investment to drive company strategy, IPO buyout, benchmarking performance, stock options and warranties. These are all things that we can do with a value. And sorry, guys, the reason why I just glanced on the price is not value, I already told you my SiriusMD story. So that was what went with that slide. So let's just move on, because I want to make sure I get some coverage. How are we doing with rate of speed? Am I okay, Elizabeth? I know we have a lot of. Okay.
Nope, you're just fine.
So valuation is part of your funding cycle. We talked about this. So I talked to you earlier about valuations continuous, right? Should be tied to your strategy. Valuation, both for the 50% of us that are founders and for the 50% of us that are investors, the valuation is critically important to both sides. And it may be a little bit counterintuitive, because some of you on the founder side may be suspicious, and that Dave Jaraka is going to come in and try and drive down the valuation of my company because he wants to get the best deal, right? Joshua and Ignacio have heard from me, at least on many occasions. I, as the investor, I'm actually looking at not just your product, right? I'm not just your business, but I'm looking at the opportunity, and that really includes the deal structure and things like that. But you see in terms of valuation that surprisingly, more often than not, investors and entrepreneurs are kind of aligned on this, and you'll see that shortly. I do think I retire some of my question risk with that bottom arrow, but well, let's talk about this. So there are stages of company development, right? You have the seed. We have friends, family, and fools, the triple F. Sometimes it's just friends and family, but sometimes you are able to huckster your next door neighbor who's never invested a day in their life. Caitlin's making a snarky face there. Caitlin, you just happen to be my eyeball, so that's why I'm picking on you. I can actually just see you.
I don't mind being picked on at all. I've been in that situation, and it's a difficult situation as a founder to know what to do with the people in that space.
Yes, and yes, as we talk about that, I have a great friend, a great mutual friend, some of the folks on this call, Faz Bashi from Life Science Angels, and one of the things that I've learned from him is keep in mind you are what your cap table says you are. So just think about that, right? So if you have like 80 friends and family people, that's a lot of people on your cap table. So are you a professional business, or are you like spending all your time as a hobbyist? But the seed to early stage to expansion, you guys could read the words just as well as I could to later stage. But this is kind of the take home, right? Value increases, ideally doubling for every 18 months. I mean, that's kind of not a F equals MA or V equals IR, depending on which version of engineering you are. But that's kind of just a rule of thumb, right? Again, in life sciences, that valuation's probably not doubling every 18 months because that's driven on milestones, right? So if we're a play life sciences game, what would I expect to see? Idea is worth some level of value, right?
Mhm.
Probably not much. IP coming through on that idea means that idea is worth more, right? That idea in animal is now worth a little bit more than just IP. If I've done my first in human, it's worth more, right? So this is just kind of that idea of what are the value drivers and how do you actually increase value, okay? And it corresponds to the stages of the company. Let's pick this up a little bit. So hopefully you just saw with just that little hand signal I gave you, it's not an isolated process, right? Your value is changing with time. And we think about value in terms of portfolio, right? It's not just you arbitrarily, the Dave Giroco company. It's a function of kind of the market you play in, right? And whether you're in life sciences or software as a service, but when you come into that investor, you're meeting that investor, you're meeting that angel organization at a certain moment in time. So your value 6 months from now or 6 months ago could likely be different than the moment you cross. So let's imagine, let's just play this a little bit. And I'm not going to pick, this slide's talking a lot about the metrics, right? Okay, 65% of the portfolio fails, or, this is the infamous 2/3, 1/3, right? And so what's the infamous 2/3, 1/3? 1/3 of the successes have to make up for the 2/3 of losses, right? So you need a high return. You need like, a 20x on those 1/3. And that's why they think about, okay, what's going on in my portfolio? So John, I'm going to tease because I just see him, and now all of a sudden he's going to say, crap, if I don't think this investment is going to be a 30x, I have to make up for a lot of dogs that I'm dying. So now I'm going to be a little bit more specific with my dollars, right? The other thing to think about is, and I'm sure Apis has seen this as well, Seattle, is like 18 months ago, no one was ever trying to pitch me a COVID-19 test. And not a week goes by now that someone doesn't have their COVID-19 test. And I'm now being a contrarian, which is like, hey, by the time you get to the market, what market are you fighting for? Right. So that's a little bit of, investors think about value in terms of their portfolio. You're tied to the timing. Okay. My kind of favorite, and this is kind of hard to explain, but the bottom line on this slide for me is, don't say you're coming at me with a note, and I've already teased John, so I'll go to the well one more time. Don't sell me in a convertible note because you can't figure out how you value your company, because by the mere fact you're hitting me with a convertible note, you've thought about a level of value, right? So that's my plug for the investor side, right? I gave my little, so that was my anti-founder statement, but that makes up for all the other pro-founder stuff early. So I'm just trying to be equal. The reason why I want equities, it's just a better opportunity for the investor. So both, let's look at this way. Let me put it from a perspective of Rockies. We'll entertain notes and private equity. So don't think I'm saying no to that. But the vast majority, over 50% of our investments, are on a private equity side, a PE side versus the convertible note side. A deal that's the same deal will look more favorably on the equity side versus the note side. It just is a way of, hey, you may get that deal done with a convertible note. You may get that same deal done with a SAFE or a KISS. And I'm not talking about either of those, because yes, I know they exist. You further west of Colorado folks look at those things a little bit more often than we do. But that's a deal killer. And John's doing what I did, is that we'll go through a screening thing. And the first thing we do is we look at easy things, which is like, wow, they're trying to pitch us a SAFE, or they're trying to pitch us a KISS. And we're like, next, because you're looking at 12 deals, right? To say, okay, who are the 3 founders we want to hear their story? So bottom line, I've probably pulled some stuff in here, but the point of this slide is that, hey, if you're telling me you're coming up with a note because you can't think about what your value is, you're still thinking about what your value is, okay? Convertible note is probably a little bit cheaper from a legal side to put together, but don't think about it from the fact that it allows you to avoid the value question, because you're not, okay? All right, so we talked about that, valuation cap, no avoiding valuation. So this is where we get to some of the trick question stuff. So since we have about 50-50, so which scenario is better for the entrepreneur? All right. So we know with hindsight, because hindsight's always 20, that the business is really, really, really worth $3 million. How do we know this? We have some sort of magical tool. Trust me. So here's one opportunity. The entrepreneur negotiates equity investment at a valuation of 2.9. The entrepreneur negotiates an equity investment at a valuation of 6. So what's better for the entrepreneur? And
Are these with the same investor?
Right,
Or are they
yeah,
different investors?
Ask Carolyn. Yeah, same investor.
Name investors.
Caitlin.
This is just,
you
we're just
should
dialing the
answer
knob
this.
of valuation. Sorry. Go ahead, John.
Caitlin should answer this.
I might have a bit of a contrarian position on this, but I think it depends how many more rounds you need to raise after this, because getting your round too high of a valuation now could be a problem driving a down round later. If this is your last round and you're worried about dilution ahead of an exit, then you may be looking for the higher valuation.
Caitlin, I'm looking at my notes to see if you missed anything. So far, so good. Caitlin's spot on, right? Which is the game, you don't want to necessarily drive your maximal value, right? Because it does put you at risk, right? Caitlin said it there, is what happens if you miss your milestones and all of a sudden the company that was worth something, I don't want to get into, because we're not talking pre and post money, it was worth something now. If you don't execute those milestones, that company is now worth less. And you've diluted investors whose next decision may be, we got to get rid of Caitlin because she's a schmo, right? She took our money and missed it, right? So it isn't always in your best interest to drive valuation super duper high, right? As the entrepreneur, Caitlin did a great job. There's other things we could talk about, but it's a multifaceted decision. And it's killing me, so I might as well say it now because it's the investor 101. I will give the founder the value term. They can make it whatever they want, but I'll own every other term on the term sheet, and I can have a better deal, right? So it's and everyone who's been through that knows that it's because you can just valuation is just one of the terms. It's a significant one. Don't get me wrong, but is not the only term that the investors care about, nor should it be the only term that the founder cares about. And it really is, first of all, I've never seen anything get adversarial, right? So that's always kind of mythical, but that's the fun stuff to talk about. You kind of create these war stories. But the bottom line is you really want to focus broadly on what the opportunity is, right? And that's all the terms in the term sheet. So that's good job, Caitlin. So now the next one is really targeted. There's the down round. So Caitlin brought that up, and that was one of the things. So I did add a little bit more content on the down round, but we talked about it, right? Simply put, you need more capital than you thought to get to the milestones that you already said the capital was going to get you to, right? So you said you were worth 6 million, you had raised 3 million to get there, you didn't get your 510K because you worked with Michelle and she said you're a bunch of schmucks and we need to do more testing because you guys didn't think through this. And next thing you need to know is like, okay, this valuation was predicated on achieving 510K. I didn't get it. I still need to get my 510K in the med device world to be able to sell. So now I've got out and go raise some more money, right? The dreaded down round. And it's really straightforward and in a boring sort of way, right? Sell the capital, lower price per share. Elizabeth, John, and I are not happy now because we are losing money, right? We're getting devalued, but we're saying, okay, great. I'd rather have something than nothing. So we'll probably buy into that. But the alternatives are company could cut its burn rate. You slow down. Time is never a startup company's friend, ever. The market moves while you're wasting time. You could try and get a bridge, and that happens, right? You try and get some bridge financing. You renegotiate with your current investors, right? Which then makes, as we were just talking about, unhappy investors, or you shut the company down, right? So those are the downsides, sorry guys, for not more creative, of the down round. And even a bridge is not great. The startup world, as I just get a little bit philosophical, it's about momentum, right? And even a bridge is slowing your momentum. And that momentum is two things, right? Real live achievement momentum, but it's also psychological momentum, emotional momentum, right? People just like see things trucking along because it just gives you reason to believe. It's this cadence. All right, so here's which scenario is best for the investor. So again, we know that in hindsight, the valuation is 3 million. So the investor negotiates a valuation of 3.1, or the investor negotiates an equity valuation of 1.5. What is better for the investor?
Ask Wes.
Well, I would come back with the kind of it depends answer. I mean, at the end of the day, I want to find something that's within a reasonable range. If the valuation turns out being around 3 million and I'm getting at 1.5, yes, I got a good deal, but for future business flow, for follow-on rounds, things like that, that could potentially affect reputation. But yeah, I mean, mathematically speaking, B would be the better deal.
And Wes, thanks, because you highlighted what are the risks for getting the better deal, right? The better deal are, hey, what if you and Caitlin mentioned, what if you need more rounds? If you devalue the company now and they achieve some stuff, it's hard to get to the end values, right? So having a really good deal early on may be hard to get to the value at the end near the multiples where you have the 4 and 5x because you started too low. What if they actually needed more capital, right? Because you lowered their value, their ability to raise more capital without diluting everybody is a lot harder, right? And that's some of the stuff which is kind of the craziness of the life sciences, right? You really need, it's a capital intensive game, right? So you really need a certain kernel of value in the life science space to be able to raise that round to achieve the milestones. If you're in a biotech development side, even after you exhaust all your great federal money, you're gonna need like a $10 million round. Well, that's hard to raise if your valuation is $10 million, right? Because you're not gonna go out and sell 50% of your company at that moment in time, right? So if you're taking the rule of thumb that every round is like 20% of your company, and let's just go to that $10 million round, well, that company's gotta be worth $40 million at that moment, right? So, Wes, I appreciate you talking about the math and kind of the more strategic elements, but great answer. So Elizabeth, the team is 2 for 2 in terms of not taking the bait. So there was some question to this. Most deals have 2 to 4 rounds. I have a little thing, one of the spaces I care about, just because I know, and let's see, sorry guys, I should have done this math, A, B, C, D, E. So I have, for a little small niche of the med device world and hemodynamic monitoring, that most of the rounds would fit in that 2 to 4 round. I can think of one that was E, so that was 5 rounds. We on the early investor side are worried about dilution. We're worried about dilution, I would say, though, to the point of we expect to get diluted, right? We fundamentally expect to get diluted. And in that dilution, we expect what we have to be worth more, right? So we're not expecting to own the same percentage. We're owning our percentage to be more valuable as it goes down. But what we don't want to do is being diluted out. we want our smaller piece to be worth more, right? Our 1,000 shares at $10, we hope it's 1,000 shares that's at $100, and we're a smaller percentage of the overall ownership, right? Because at the end of the game, that's what matters, is how is your stock price going up, right? But that's the brief on dilution. Sorry, go ahead.
Do you want to talk about dilution of the founders here?
I can. Well, the question of the dilution of the founders was, hey, how much of the company am I going to own after 3 to 4 rounds? And it kind of depends, right? It's like, what is the value of your company? How much are you raising? If you're okay with gross rules of thumb, I'll answer the question from a gross rule of thumb. You have to kind of think with that one, which is, what is your capital stack, right? What is the overall capital requirements you need to get to the equity event, right? So if you need 5 rounds, right? Because you say, okay, the 5th round is 50 million, and I'm just going to make up wild ass numbers, right? And the 4th round is 40 million, the 3rd round is 30 million. You got to think about what those capital requirements are. And if you think every time you're raising it, you're trying to sell no more than 20% of the company, right? That kind of gives you a sense. Now, that's not to say, okay, obviously, because you're not selling it out in 20% buckets, right? Because after 5 rounds, you'd own 0, but it's 20% of what's left,
Next, yeah.
right? So, and I'm doing this without doing some math, so John, check me if I do some bad math. But, after 3 to 4 rounds, you're probably in that 10 to 15% range, but that shouldn't be bad as long as the valuation is going up, right? Because that, 100% of 1 million is worth way less than 10% of 100 million. Right? And that's what you want your company to be doing. It's, again, not how much, yes, how much you have matters, but it's how much is the value of what you have matters more.
So
Okay?
we'll agree with the math on that.
So now we get into a little bit more of the details, and of course, this is what happens all the time when I get to the section, because this is a little bit of the detail. Bottom line on this is you don't want to just have one single way of valuing your company, right? You want to look at it a couple different ways. And yes, I was an engineer, so just think about, you want to triangulate, right? Through 3 points, and in the middle between those 3 points is some truth. The other part of those 3 points is it allows me to have a space that I know I'm okay existing in, right? So I can negotiate now with Elizabeth and say, okay, I've kind of created this value space, and psychologically I should be okay in any one of those spaces as long as it fits into your strategy, right? You just can't do your valuation without thinking about what your overall game is. But now I can say, hey, I'm going to go to this lower corner because I want this term in the term sheet that angel group really seems to be concerned about, but I want it this way, whatever that term is, right? It doesn't really matter. But you want to really have a bunch of different ways of looking at your business. So here's one. So I kind of like, so it's, guys, these are not a lot of hard math ones. These are all straightforward, no Excel spreadsheet kind of looks early on. So scorecard method, similar to real estate appraisals. Someone hit me with the notes like, hey, these are based on like some sort of industry comps, right? So scorecard and risk are kind of starting with industry comps, and you'll see that. So so what do I mean by that? The valuation of a life sciences company and the valuation of a consumer packaged good company is going to start with a different basis, right? Because the life science company is probably going to be worth more at a similar stage from the consumer packaged goods, all things equal, right? And you'll see that a little bit in terms of these calculations. But you start with an average valuation at your stage, in your industry, in your region. And yes, guys, you can get this information. I'm a cheapie, so I don't have PitchBook, but I can tell you, I do Crunchbase, and I can tell you for that little mythical space I was talking to you guys earlier about hemodynamic monitoring, I could tell you that everyone's first raise was between $2 and $4 million, right? And I could tell where they were in a product lifecycle that says, okay, I could probably safely say, because these are early stages. So John or Elizabeth, allow me to just kind of mix my language here. I could probably safely say I can start with a $2 million valuation for my company, and I'm mixing my metaphors here just to make some time. But you can find this stuff out, and I'll share you some stuff as we go along. Mm-hmm. So here I actually took someone's comment. So hey, how do I get a sense of these market norms, right? How valuations determine, in my opinion, early stages, very close to market norms, quality of the founding team, founders with prior success, people coming out of other well-known startups, abandoned valuations in each industry, geography, although I think this differential is reducing over time. I think the differential is changing, but it always seems to, California always seems to be a premium, and I'll show you that in a second. So here, I'm pretty topical. So again, a plug for what Elizabeth said, make use of your Angel Capital Association membership, because you could do what I just did. So this is the median valuation and round step-ups for 2019, right? So this is less than 2 years ago. And the point of this is just showing you what typical round sizes are. And I was just able to get that from the Angel Capital Association, which is being reported out from the members, okay? Another thing you could get at, and I'm just doing this quickly so you can see the scorecard, is from the funders report, you can see life sciences industry and the valuations versus, so life sciences being medical and health tech versus fintech, right? Those are the top three, versus e-commerce on the bottom. This is to show you that they're based on norms, right? From depending on what vertical you're serving. And then West Coast deals have higher valuations. So the funny part is, right, California is called out by itself. And if you look at it from an Angel Capital Association side, I bet you most of the faces on this call all are deemed to be West, because I know Colorado is. So I'm other than my Boston compatriot, Christiana, I think I may be the furthest in the Baltimore folks. Colorado is relatively east from the Pacific, but we're still thrown into the West. So that's where our data would be. But you can kind of see where the deal valuations, and remember, this is an angel report, right? So angels typically are in, pre-seed, seed, and maybe A, right? So with that, I'm trying to describe for you those early stage rounds. And then, so average company valuation. So with the scorecard, I say, and this was a little bit ago, but this would really be kind of the average Colorado deal size, right? It's a $3 million initial valuation. So you can kind of see the factors we assess: team, opportunity, product, competitive environment, market sales, need for additional investment. Where are Elizabeth and Dave and John and Michelle getting that from? We're getting that from your pitch to us, right? We're getting that from your pitch. We're getting that from your data room. And then we'll have a weight to these things, right? So we're saying, hey, team is the most important thing. So the person that said founders and their experiences, we're saying that's 30% of the weight. Market size is 25%. This is the old jockey, right? What do you invest in, the jockey of the horse? This is telling you invest in the jockey. So you can see the weights going down the first column. And then the impact of those weights is in the second column. Guys, this is just an arbitrary way we do it. As long as you do it, the weights and the next multiple are arbitrary, where we're picking those numbers and we're consistent with that within Rockies. And then that gets us a factor, right? 0.6, 0.5, it's just straight math going across. And what we do is we use that number to then offset, we take it against this initial market size, and we see the value of using the scorecard is 4.875 million. Okay. So, hey, if you have a good team, that can give you a good impact, right? That's an uplift. If you need additional investment, that's a lowering of the value, right? Because there's more risk. So this is one way to value a company. And it really is that simple. It is qualitative, right? It's a qualitative, quantitative way.
Mm-hmm.
So we have another one, which is the risk factor. So we start with a baseline again. You consider and assess risk. You decide ups or downs, right? Puts or takes, pluses or minuses. And then we go and just do some boring algebra, right? So a maximum minimum is +3 or -3. So for example, stage of business, if you have paying customers, again, in life sciences, you would, this is maybe you adjust the metric, right? Because if you're an angel investment in life sciences that is paying customers, I want to meet you as a founder because damn, you've got something figured out. But the point of this is that you're going to have things that are for the category and you're just using it to differentiate the opportunities. Okay. And you can see for a +1, you're adding 100K to value. For a -3, you're subtracting 300K of value. And you can see a little bit different factors: tech risk, execution risk, market risk. And you can see you sum up all the numbers: +6 going in the right direction, 7 in the bottom direction. Okay, that's a -1. The average in this space is 3.5. We take the -100, it's a 3.4. So now let's assume that the scorecard and the risk method were for the same company. First method said, hey, the company's worth 4.8, if I remember right. The next one's saying it's worth 3.5. Do you see how we're starting to triangulate a little bit? Burn rate based value. So this is kind of interesting, right? Because if I probably wouldn't recommend it in a vacuum, right? Because you're saying, wait, you could tell me my valuation based on how I'm burning cash. That really seems ultra counterintuitive, right? But you can actually, if you just follow it, it's okay. You're going to calculate your burn rate and the total funds you need, give yourself some sort of safety net, right? Because your burn rate is based on what you're actually spending. Your valuation is your total burn rate plus your safety net, and you test it against your exit strategy, i.e. how much money will I need? So then let's look at this example. So the burn rate is 25,000 per month. We'll tease Wes. So Wes is one of those weird founders. He's paying himself 25,000 bucks a month, and that's where the burn rate is. Obviously, nothing ever happens that way. And 18 months are needed to get to a major milestone, whether that's product complete. So 25,000 times 18 months, right? It's 450,000. Let's give ourselves that 20 to 50% cushion, right? It's 500,000. So I'm raising 500,000 and I'm selling 25% of my equity, 25% of my company. What's the value? So this is a good test of pre-money, post-money. And I haven't explained pre-money, post-money, but anyone brave enough to venture a guess? All right, go ahead, Caitlin.
Sure. Pre-money is before the investment goes in, post-money is after.
Yes, ma'am.
So it's really just addition. It's not nearly as complicated as it sounds when it's being
it's just getting the terms right. But if you think about it, so I'm going to own, if I invest $500,000 to get 25% ownership, my ownership is calculated on the post money, right? So that's basically saying that $500,000 is 25% of what number, right? That's all it is. And oh, by the way, 500,000 is 25% of 2 million. Yeah. Right? Which means the pre-money is 2 million less 500,000 is 1.5, right? And let's see if we got that. Woohoo! Right. So we got that doing it there. Again, this is just a way to start saying, what could my valuation be? Right. It's just ways to help you start thinking through this. And no single method is the best method, but in putting them together and integrating it, it starts giving you a sense of truth. And you can imagine as an investor, if I had an entrepreneur telling me, here's a couple of the ways we thought about how we could value ourselves, and this is how it plays out with our future, and this is what it means to you. That's a way different conversation than if Jay Giraco goes to John and says, I don't know what I'm worth. John's like, great. You don't know what you're worth? I mean, it's a diff versus like, hey, I think I'm worth between 3.5 and 4.5 for these dynamics. Now we can engage in the conversation. Well, why do you think that? Right? I mean, it's taking that valuation to the next level pretty quickly. Should the total burn equal the raise amount? So the total raise should be equal to the amount needed to get to cash flow positive exit or the next round, right? You want that to get you to your next milestone. Why? Because you've risk retired and you're worth more. That's just the way it goes back to a little vicious cycle in the beginning. And Elizabeth, I'm keeping track of time. I see in the corner of my eye. So the venture capital method, right? 2 factors, your ultimate liquidation and your risk factors in getting there. Determining exit value, model future cash flows, bottom-up analysis, not just a percent of the market. This is a good way for me to pause. Let me just back up a little bit because Elizabeth alluded to my corporate background. And this is where I bristle a little bit when a founder, an entrepreneur say, well, I can't tell you what I'm worth because I don't know, I can't figure out what I'm going to sell. Well, when I was at Covidian, when we acquired companies and we were a pretty voracious acquirer, I had to put together a 10-year pro forma. And yes, I had to put together a 10-year pro forma to say to the board what Caitlin's company would be worth in our hands. So when someone can't tell me what they can't forecast the next 3 years, I'm saying I had to forecast 10 years. And if I had to live through 10 years, and you guys know like years 8 and 9 are garbage, but you still have to go through the mechanics, right? Because you need to think through what are the revenue possibilities and what are the investments I need to get to that revenue. And if you're going to sell out to a strategic, they are typically going to do that, right? So they're going to have this big Excel spreadsheet muscle. Now, I will tell you, you have to know your strategic, right? Because I wouldn't suggest to a founder entering a strategic conversation if the strategic themselves don't do that. I think it's a good discipline to do that, but I've learned recently that not all acquirers actually go to the effort to actually put together a 10-year revenue model, which is dumbfounding to me because you really need to think through what that means to the business. But the point of this is you model cash flows. That's what I was doing at Covidian. I'm modeling cash flows. You adjust for risk, right? Market risk. You research the trends. Is this a growing market? How fast is this growing? Document multiples of EBITDA, client, yada, yada, right? This is a pro forma. This is a 10-year pro forma, a net present value, discounted cash flow model for you guys that like to turn spreadsheets. That was a pandering to John. John smiled. We got a big smile out of John on that one. But here's kind of a distillation, right? Investment is 1 million. The exit year is year 5. The revenue is 10 million. The EBITDA is 1, right? Guys, we're doing this quickly because no one wants to sit through this in a call. Price revenues, right? So this is a little bit of, this is where the simple are the important things, right? What has happened in your industry, right? If everyone's getting acquired at 10x and you put 5x in here, you're discounting yourself. Compare to yourself what's happening in the market. By the same token, make sure your comps, right? This is the real estate component. This is like the wheat bread picture. Are you picking the right comps, right? Are you picking the companies that look most like you in the spaces? Because I've had people talk to me about, well, here are the comps. And when they show us the comps, it's been for companies been at it for 10 years and they're doing it in 3. And I'm like, what secret sauce have you figured out? You know, because you can ask those questions, right? You don't have to know anything about the space, but you can ask that question. But knowing what's reality is the big driver of the value here, right? Because that sets your terminal value. And then target IRR, target investment multiple. Now your post money is 5 million. And so the pre-money, guys, is investment less post, right? And that tells you what your pre-money is, right? So it's 4 million. And I'm picking up speed because I just see that clock ticking and it might as well be banging like Big Ben. So here's a way to look at it. The cap table method. Assume $100 million exit. You've put 10 million's been put in. and we have a $2 million Series A and an $8 million Series B. So this is getting at kind of capital stack, right? We're doing it a little bit backwards, but if you think about what you need capital wise, and you can stack it forward. So the bottom is, if we're looking to have a 5x exit, right, and it's on a post money of 20, right, because that's what would be the post money. So let's work backwards now. It's a $100 million exit. We're going to divide by 5 because it's a 5x return. We could really have no more than $20 million of value into the company, right? If in my B, I need 8, because I need $8 million of whatever, right? I need $8 million of manufacturing line. That means 20 less 8 is 12, right? So now, red is the 8. So again, 100 is what I exit for. It's a 5x space, right? That's what the exits are. So that means I'm dealing with 20. Going through this one more time. I know I needed 8. So that means I could only have 12, right? And then, so now I'm 12, and now I'm like, okay, well, what could I do what are my possibilities here from an initial raise, right? I can do 2, I can do 3. It's just an easy way to back into it based on what your space does to say, is your capital stack feasible? And then obviously, guys, the more rounds, the more A's, B's, C's, D's, and E's, this gets pretty complicated to do this just like I did optically, right? You're going to have to really think through that. But this is why having a strategy and knowing your access to capital matters in a go forward. So I probably beat this, right? I said create multiple scenarios, identify all risk. What can you learn from each of the scenarios? So this is kind of a summary, right? So this is the type A founder. They've done, and I didn't do the gut check method. That's just from when we teach it. So this type A overachiever founder did 5 different valuation methods, right? They did the venture capital, they did a scorecard, they did a risk, cap table, burn rate method. So you can see the range of value. You can see the standard deviation, the median, and the average. So now you as a founder say, okay, my company's worth in this 4.4 to let's say 4.7 kind of range. And these are the reasons why. It just allows you to tell your story. Okay, oh, look at that. So your value story. It's really about the story you tell. So now we go back to, if I knew that to be the case, and now I go back to my Cirrus MD story, and Chris came in and said, this is what we agree we're worth that, but the reason why we're coming a little bit lower is because we need the money now. We really want to incent the investors to be able to buy more sooner so we can get moving forward faster, right? So it's how do you tell your story? Because that's a logical story, right? John's not saying, well, shit, Chris doesn't know the value of his company. He knows the value of his company, but he also knows the value of time, and he wants it to be an easy raise. He doesn't want to be at the raise for 12 months, right? These are the things that fit into this in valuation. No one values right? It's a balance of analytical, intuitive, transparency for coming to agreement. And we talked about this. Exit strategy drives valuation. I think I just showed you that just in the model where we went backwards. So kind of just linking it together a little bit. So I think I actually wound up doing this a lot earlier. So valuation is the money prior to investment, right? Before you get that, valuation is your pre-money. So it's what your company's worth before you get. Post money is what your company is worth plus the dilutive capital you got. And the founders in this case, so if you have $1 million and you get $500,000 investment, the company's worth 1.5, and very simply put, the founder's post-investment equity is 66%, right? So they went from 100% of $1 million to 66% of 1.5. Okay. Net present value.
And you wouldn't have got to 1.5 if you hadn't actually had someone give you some money to move your signal on.
Right. Yeah. This $500,000 isn't just, it's not like Publishers Clearinghouse as I age myself. It's not like Ed McMahon, God rest his soul, is coming up with a big rubber check. I'm just going to skip through this. This is just another calculation. 10X. I think I talked about this a little bit earlier. You know, how does 10X factor into this? This goes back to a third of the investments have to be over 10X because everything else are dogs, right? This gets at portfolio management, that little slide there. And I think, you know, just putting the pieces back together or collecting all the things in my PDF home move. So let's see how well I did addressing valuations are determined multiple factors. Hopefully I kind of showed you that. So I'm gonna look for either head shakes, or you guys can go north and south or east and west as I go through this. So valuations determined with multiple factors. We talked a little bit about dilution and valuation. Who determines the valuation? In the best of both, in the best world, it's a combination of the founding team and the investors. Now within the investor pool, like let's say it's a syndicated deal, it is your lead investor that is working with the team, because the lead investor sets the term sheet, not just the value, right? But all the terms of a term sheet, right? That's coming from your lead investor. And a good lead investor wants a boring ass term sheet. They want a vanilla term sheet, because the more esoteric the first term sheet gets, that opens up every other term sheet to get wild and woolly from there. And no one wins at that point. So if you have, and that's should be your litmus test of any good angel organization. You already see John Chicken has said the same way, which is if they're asking for a really weird term sheet, that should be your sign, like maybe you're not with the right group, because I've never seen one of my angel colleagues disagree on that vanilla term sheet concept, because everyone's been burned by a non-vanilla term sheet. What is the expected increase in valuation between rounds? It's going to depend on industry, right? Because they're all a little bit different, but 18, 24, 36, you know, it really depends on how those milestones, right? And how your milestones drive value inflections because you've retired risk. Equity option pool affect valuation. I didn't touch upon this because I really didn't want to get to a cap table model, but I will speak a little bit about equity valuation because I agree with the tone of what was written in there. As a founder, you almost want from day one thinking about what your equity pool is, because at some point someone's going to force one on you, and you might as well start from the beginning versus have to account for that in some sort of round dilution that makes someone pissed off somewhere. I mean, that's kind of what I would deal with. So a smart founder should not have 100% of the company. They should already start from planning like, okay, I can't possibly do this by myself. I'm going to need to bring people on board. How do I make sure I'm accounting for maybe not what we'd say ideally is 20%, right? An option pool. Maybe you don't go that far because you don't want to be that generous, but start thinking about an option pool, because the lack of doing that will cause some dilution problems for everybody, not just the founder. And a good founder is going to want to do this job again. And they're going to want to, right, which is get back on the hamster wheel. So the better you get at that is because you have great relationships with all the early stage investors, right? So be easy to do business with, right? That's just kind of my advice, because otherwise you will live your karma and you'll be a one and done.
Do you want to talk about, while we're talking staff equity option pool, your advisors and what kind of percentage you should be holding for that?
You know, it's fractions of percentages in my mind, right? And there's going to be some version of cliff. They've got to be with you for a little bit before they see anything. And then that should accrue on some sort of interval, monthly, quarterly, yearly, you know, it depends on how you negotiate that. But there are kind of conventions, you know, anything that's what would get my attention, right, is anything I'll give you an artificial Mason-Dixon line. If you're north of 1%, that's going to catch my attention. If you're less than 1%, I'm going to start saying you're in industry norms. If I not try and be, you know, I'm in the 0.2, 0.3, 0.4% of equity with a cliff. I mean, those are kind of the norms. If you're seeing advisors, I'd be like, what's that advisor doing for 10%? You know, like, is that Yoda and the only one that can give you that advice? And I'm sure, you know, Elizabeth and John and other people can tell this story. I've seen people on a cap table where I've been the pro bono advisor from the state, and this person's on the cap table and they've never attended a single meeting, and I've been advising them for 2 years. So I'm like, what the hell is this doctor doing for their share? And now the founders finally said, we've got to get so-and-so off the cap table, right? Because they now have not provided any value.
We've had
Elizabeth, did I kind of answer the question, or did you want
Yeah,
more?
and I just had a pitch where someone said at 2% and no vesting. And so we said, oh, maybe not.
Yeah, I mean, you want to have access to the right people at the right time. But you're going to want to that'll come up in your diligence files and people say, what is this person doing for that 10% or that 2% or that 5%? Down round, we talked about pre-money, how that changes. Do valuations change for different types of stages or companies? I think we talked about that. And in my experience, I think I gave some notional stuff. It's really hard to give an absolute hard and fast number because it really is dependent on the strategy and how much capital that founder will really need. Because the more capital you need, the more diluted down you're going to be, because it just is, right? So if you're that small molecule founder, you're going to get diluted down. But if your exit is $1 billion exit, you're going to get some money. I mean, it's just, you got to think about how is your share price going up every time you achieve a milestone. So I think that should open us up for questions. And I know, guys, I went fast, but I really wanted, Ignacio and Joshua could tell you my normal MO is I take a lot more questions in the middle of the presentation so I don't get to the end and run out of time. So I went through this even quicker just to make sure we could have a dialogue, and Elizabeth said she'd kill me if I didn't. So those are the two reasons. So I could probably stop sharing so you could see faces a little bit better.
Okay, that sounds
David,
good.
I'll throw out a big one here. So you went through all of these different models and you essentially said this company is worth somewhere in the 4 to 5 million if we want to even take kind of the outside of that range, right? If you're advising an investor or a founder, from your perspective, at that point, if you're in somewhere in 4 to 5, is valuation even a variable anymore? Or are there other things that you think are more important? How much would you even negotiate between 4 and 5 versus getting the right relationship between founder and investor, getting the right terms, kind of some of those other things?
Yeah. So Caitlin, I'll give you the really flippant answer, which is, there's really no appreciable difference between 4 and 4, even in 4 or 5, in my mind, without knowing what I'm raising against that value, right? So that $500,000 could be significant if it's significant comes in terms of the capital I'm trying to raise in that round. And if that $500,000 delta is what prevents me from getting to the next milestone that opens up a lot more value, I may fight for that a little bit more. So let's say, and I'm going to make numbers that don't make sense. Let me make numbers that make a little bit of sense, I guess. So let's say it's 4 and I'm trying to raise 2, right? So at the end, I would have sold, 2 million of a 6 million, right? So it's roughly 33%, right? But if I could get that $500,000 and now I'm all of a sudden at 2.5, Caitlin, and that gets me the high price regulatory consultant, let's call her Michelle, that gets me my 510K in a timely fashion, that may be worth fighting for. So it does depend a little bit on the specifics, but in a vacuum, I wouldn't have a lot of heartburn on that big of a delta, because because now you probably have a good deal, right? I mean, now put your John Seacrest hat on or your Elizabeth Cross hat. It's like, hey, that may be a good deal, right? And this is one of the things, right? I preferentially invest in life sciences, right? Even though I said I have other things. I mean, it's the space I know, so I could do a lot more vetting. Like, hey, that doesn't make any sense. But for me, table stakes is I'm investing in a space where it's like every investment I make is doing good, right? So when someone says, well, I'm curing cancer, well, you're the 5th pitch I've seen that's curing cancer today. So the reason why I say that is that, but if you're the 5th pitch that's curing cancer and you're freaking a great deal, all things equal, I'm like, maybe I'll put more money into that deal because it's a better deal for me. And remember, we as the investors are investing in the product, the business, and the deal. So we look at the holism, right? Is it a good deal? And sometimes it even matters, because states have the incentives, right? There was the state of Colorado is driving 3 verticals right now, which is life sciences, pure tech, and green tech, right? Because they're trying to, drive those economies. And I was able to invest in a company that actually had tax credits that I was able to use. So it extended my investment, right? I got 20% on my investment right there. So that's a good deal, right? And that wasn't, it wasn't Caitlin the entrepreneur. It happened to be the industry that Caitlin was in, right? So that's part of that dynamic too. Other questions? Let's say I see. Probably should go to
So here's a question: Would investors be scared in getting a return in 10 years than 5 years? So life sciences, sometimes we say that they develop quickly and then exit quickly, and otherwise they take a little bit longer to show their reach their milestones before they exit. Where's the return? Are you scared of longer terms?
Yeah. So, all right. So we'll give my honest and then I'll give my more measured. Like, wow, the question was kind of scary, just phrased that way when you see it 10 versus 5. But the answer becomes is I'm not a venture capitalist, right? I'm an angel. So I'm a little bit more sensitive to time than a fund, right? Because a fund is probably going to exist for 10 years before they shut it down. But for me as an angel in an angel group, 10 years is a scary proposition, right? Because we look a little bit more at IRR measures versus the multiples. So time does matter to me. Now the more practical answer is, do I get more money? Is it a better overall investment in 10 years? Because I'm assuming more risk, right? So now I have to figure out what my risk profile is. So as an angel, yeah, 10 years is not going to thrill me, but I may say, let me think about this. Is this business opportunity? Will I see the way it unfolds? Will I see other measures of risk retirement that makes me feel comfortable with that return, right? So quick answer is I would get concerned, but I would peel it back a little bit. You know, what is the market doing? What are the other dynamics? Sorry, maybe I over-answered that, but that's, yeah, you know, it's very easy in a vacuum to say that one thing scares you away, but you need to know the whole opportunity.
Right. So we've got Jason asking a question. I have a person on my cap table at 1.5%. They were initially utilizing their lab to substantiate my company's technology in an animal model. Can you read this? We happen to work in lung injury. He happened to work in lung injury, and now has preliminary work that suggests that he can evaluate lung injury severity using Vivid's technology, which is Jason's company.
I would say, well, you know what, Jason, hang on one second. So I will put mine next. So you have a bunch of other investors here. So this is an investor's perspective question. So before I answer, other thoughts from the investors on this? How do you react to that?
Well, the next part is it could lead to the development of a diagnostic in the space. And
yeah,
so
I read through that. Sorry.
Yeah, yeah.
So I mean, half of you invest. So someone be brave. How do you take that information?
Yeah, Dennis, what do you think?
I don't know. It's mostly it's a time sensitive kind of a measurement. So it's hard to actually put a value on that. You have to be actually understand that the whole process to be able to put a dollar amount or whatever valuation you want to put onto it. So yeah, for me it's hard to decide.
Okay, how about you, John Benjamin?
I don't think I have much to add. I'm not sure how to truly compute all of this based upon this area of business. Medical.
So there's every time someone's investing in your company, you either registered the company with the SEC or you went through an exemption. It's possible for you to use Reg D 506 or whatever, but there's also Rule 701, which allows you to give equity to consultants. And there are people that do things like trade equity for rent or trade equity for equipment or all kinds of these things, and they end up on the cap table. So now one of these people ends up on the cap table. For Jason, he got some lab space. Did that save him $1 million worth of work that he didn't have to do? Or is this just a guy that was putzing and making it go? If it's $1 million worth of value, hallelujah, 1% is pretty cheap. But if it's some guy putzing, then I'm not so sure. It would definitely raise a question for me about why is this guy here? And more importantly, if he's 1% of the company, what the hell is he doing right now to help me get this company value up? And if he's not actively engaged for that 1%, I would suspect that I would be growling a little bit.
So I'm going to answer that and because of the second component and wearing my regulatory hat since Michelle's not here to wear it. But if you're going to go into the diagnostic space and you've actually proven your space in your animal model, you might actually be driving more, but he might actually be helping you drive more value in your company.
Can you put a number on that?
That John, that's exactly where I was going. So, because you could be I think everyone's comments have been spot on, Jason. So the question is, you know, what is lab space? And let's just do some easy numbers. Let's say it's $5,000 a month, and it's for a year, it's $60,000, right? So for a couple of years, it's, you know, less than $250,000 clearly. If your company goes for $100 million, did you overpay for that lab space over time? I mean, there are ways that you can quantify the value you're giving that person, and just know that you're comfortable with it. I think from a storytelling perspective, I think you could tell that story and people wouldn't necessarily blink, but as a founder, you know, there are ways to quantify and come back, you know, and it doesn't take too much outreach to any other founder to say, okay, what are the norms? You know, because when I made my transition from corporate America, I didn't know what my value was as an advisor, because in my own mind, shit, I'm invaluable, right? I mean, we all think we're invaluable. We all have a fine sense of our own inelasticity. So I talked to some of my colleagues who were founders. I said, here's kind of the range. This is what's typical. So I was like, okay, you know, and they were they helped me, you know, and it proved out, right? This 0.2, 0.3% kind of cliff stuff is kind of the norm once you talk to people there. Because you know what, you know, John and I are investing maybe advising a couple different companies. So we're collecting that 0.2, 0.3 across a couple different industries. So
David, just to clarify, Jason just
Yeah.
clarified that lab team was actually running the animal models.
Jason, this story is getting more complicated. So now I want to know how much
that changes for me completely the dynamic.
I'm not warning.
I'm going to go on. So.
Do I need to be looking for the IP? Is your IP going to clear? Is there is there a Freedom Act issue here? I'm getting nervous now.
The IP is okay. However, the application, if they're within the specific application, I might be a little within the diagnostic application. I would be a little bit more. There could be something coming in as far as between the institution and Vivid, because it is being, a lot of the specific testing is being done within the research, within that particular research lab. So that would be that might be more of a challenge as far as the IP itself, and as far as the actual manufacture of the probe. That's already I have IP protection on the technology. It would be more along the lines of the application than the technology itself.
Yeah, and Caitlin's asking some good follow-on questions there too. In all kidding aside, that I am a little bit nervous for you on the IP. So that's kind of where my head transitioned, because a life science company, because of the cycles, is so IP dependent. It is the most IP dependent industry because it takes so long to get to market, and you've really got to have that protection or exclusivity or sustained differentiation to actually get your payback. So that's why all of us life science investors, that's kind of like, so who's your IP firm, right? I mean, that's one of the first, you know, and can you smack them across the chicklets with, well, we use Wilson Sonsini, but go, okay, so you're overpaid, but we know your IP is good. Yeah. I mean, it's like those kind of things. Unlike, you know, software as a service where it's like IP, schmip, it's like, you know, go, right? Because it's all know-how.
We're going to switch and ask a question about, is there anything I should be aware of or give extra care to if the angels are outside the US? And when we had our Canadian representative on here, they could be coming from Canada, or in this case, is this
Looks like
Latin.
Asia Pacific,
Yeah.
what I call Asia Pacific in Latin America.
Yeah.
Wow. Geez, Alicia, I'm thoroughly unqualified to answer that. You know, let me answer it a different, John, let me just answer it a different way, and then you can maybe give a right answer. I always think about it as a founder, you know, remember you're asking your investors to join your team. And this reminds me of a little rubric And it's a 4-block, right? So all of you have consulted, know everything in consulting can be done with a 4-block. And so the axes are, smart and active. And so you have smart, active. And so you can be smart and dumb, active and inactive. And the one thing is what you don't want to have is active, dumb investors. And the further away they get from you, you increase those risks. That's just my kind of opinion. And you're asking them to join your team. So imagine as a founder or CEO, the leader of the company, that Dave Giarocco is calling you every week on his lousy $10,000 investment to know where you are. So it's almost not so much where they're from, but the ability to know, to kind of check the network and know what that investor's like or what that investment group is like, because they can make or break you. John, please take it away from me. I'm probably over the tips of my skis.
No, I was just going to say that we know that when European companies get US investors, that they get forced to follow SEC rules, even when they're in Europe. And so each country has their own set of rules about what offering something to an investor is. So then now you have to track all of that. So you're adding some level of complexity to that process that you need to worry about. But more importantly, at the pre-seed and seed stage, I would say that the money from an angel is the least important thing. It's the things they do to help you that is most important. And if you can't identify how they're going to help you and how they're going to be involved for a while, then probably taking their money is not the right choice. And so if you're getting far away, unsocially validated people following rules you don't understand, who are not going to help you, that sounds a lot like a no to me. And if you have somebody who's in the Philippines or Singapore who's going to double down, open up a market, drive a whole bunch of this thing, who's going to actually be a functional team member until you can hire that sales rep in Singapore, maybe that's a different story, right? But the money is sort of a bride price to hold the attention of the investor. So that investor needs to be investing enough that it holds their attention. And so if you get a Chinese fund that's worth hundreds of billions of dollars and they drop a little bit of stuff on you, and then they're going to have zigzaggy kind of engagements with you, that strikes me as trouble.
Thank you.
How did that sound, David?
Does that discourage you, Alicia, from your
No.
investors or?
No.
Just-
I feel very good about my sourcing, and I do really appreciate, David, what you said, in terms of really making sure that these are people that I want on my team. I don't know them all, but I feel really good about my gateway. So, I'll just be mindful. I am also, concerned about things like regulatory considerations, and because this is all, new to me. So I appreciate your comments also, John. Thank you.
The other thing to think about is things in the future, Alicia, like board formation and stuff like that. And, when you have 100 people, each with 1% of your company, how do you get decisions through? I mean, that's the tough part about the founder or the CEO, is that you have to be at all levels at all times and be at all times at all times, right? You have to be the one thinking about, how am I going to negotiate with that hospital system? Oh, by the way, how am I going to just get this email sent to this purchasing person, right? I mean, that kind of level. And oh, by the way, how am I going to get decisions through the board, right? Because a board, if you play that, will make or break you. I've seen some visibility where you have a bad board, and it's not because they're bad people, but sorry, that's Northeast, bad language. It's an inappropriate board for the phase of the company, right? If the company is in a pre-revenue clinical phase of the company, you want a board makeup that understands those challenges, as opposed to a board that is used to just scale up companies, right? When they're hammering you for a sales slick and you're like, shit, I'm just trying to get through regulatory right now, or I'm trying to get this pre-sub scheduled, and they're saying, show me your commercial plan for 3 years from now. You're like, yeah, it's a valuable question, but is that the valuable question at this moment in time? And they're only doing it because that's what their expertise is, you know? So it's not because they're bad people. It's just like, you know, they're playing to their strengths. Unfortunately, their strengths aren't what you need.
Well, this is a perfect segue into our last few minutes, because investors who are in SAC 20 are actually doing due diligence with the company right now. So what we want you to do is make sure that when you're asking a company a question over this week for the founders who are here and the other ones that are not, that you're actually not wasting their time. You're not taking them down a rabbit hole to ask for things that aren't going to be useful. And I think that we have to recognize that while we're doing our due diligence, you still have to move your company forward. So we're going to be wanting to ask you things that will actually prove that we can actually invest in you, but we're also going to want you to be still week over week growth is what we say.
So, Elizabeth, on that point, I do think an interesting question specifically for angel groups, right? So when you're in the diligence process with an individual investor or with a VC, you're often interacting with the partner that's going to be involved longer term. But when you're with an angel group, the diligence group may or may not be the same person who's actually your lead long term. What does that look like in terms of the doing diligence on your investors while they're doing diligence on you when you're talking about a group or a syndicate type experience?
So I'll give some example of what happens at SAC, and because we just had this conversation earlier today, John and I, about somebody who did due diligence, then became the fund manager and has followed the company over a longer period of time. What happens in other situations with SAC, John?
So we have the LLC organizer who is predetermined as the point person, right? So they're the person that will be doing the evaluation of the deal terms. So you've already had your conversation with Wes. The expected outcome is that Wes will be following the company for the duration of the deal. But it could be that the due diligence lead is the one that ends up doing that, right? So I would expect you to be having conversations with your due diligence team and conversations with Wes, because those are the two contact points.
And those are the two parallel tracks, right?
Right. But most of the time, Wes is the person, the LLC organizer, is the person that'll be contacting for the most part. In a network, as opposed to a fund, typically the people that are on due diligence are interested, and they're making a personal decision, and they're not the lead. And so they're just trying to see, am I in this deal or not? And so you need to find who the lead is and then circle all the horses around that, right? And if you don't have a lead, then cultivating one's important. And if you're going to do a party round, you are not having a lead and you're setting the deal terms, and you lose the leverage that you get from a lead investor, because lead investors are supposed to do work for you. They're supposed to help you close the round, supposed to carry you into other places so you get your follow-on introductions and so forth. David?
How does RVC work?
Yeah, so we're pretty similar. So Caitlin, let me say, you asked the questions you asked us, right? That's what you ask of the angel group, full stop. So we have, all of our angel members are volunteers. We have employees of the club, right? Just like John was alluding to, in a sense of, so Dave Harris, who I just haven't introduced John to, is a RVC person, whereas Dave Giroc is an investor member. I was the lead investor for the club on one deal, right? So I ran diligence with the support staff, asked the key questions, put together the deal memo. And we, as RVC, then acted as the lead investor, and we wound up doing the syndication. I think we were the biggest investment in the $1.7 million round. And we syndicated, we kicked it off with other life science groups. We did the work that John was alluding to, presented and pitched. But that doesn't mean that Dave Giroco, even though he was maybe the best person within RVC, if within the syndicate we thought that John was the best person to take the board seat, we would say John should be in the board because he's got some sort of space knowledge or contact set. So it is possible that even if you have a really good lead, that someone else could do it, because what RVC would do is who's the best person to help that company move, right? Back to what John said 20 minutes ago, your angel should be bringing something in addition to the money, because otherwise we would just be running all sorts of formulaic things, right? It'd just be, everything's a financial model. But we also do just like what you want to make sure is that how does your angel invest, right? So RVC creates a special purpose vehicle. We invest as an LLC, right? So even though, so this is some of the behind the scenes. So I'm cat herding 25 people who said they had committed money to make sure that we all show up as 25 to be the one, right? To be the LLC. And that's a much better place, because even to get to your 1.75, it could be all you needed was 10 angel groups, right? That's a whole different cap table than 170 friends and family.
Well, speaking about that, we're actually bringing together our Fit 40 investors to do our LLC. And if you are interested in participating in that, then feel free to reach out to John or myself.
Alicia had a question on board meetings. Alicia, I'll give you my quick answer. Sorry, there's your face. I only know the COVID world of being on the board, so I have a very skewed perspective. But I think given what boards do for the early stage companies, I don't see the expenses worth doing it in person. That's a little bit different than if I was in a different stage company, because it also gives you access to the right people. So the company that I'm a board member on, Alicia, so my N of 1, so take it for what it's worth, the board is from Maryland, Colorado, California, and Arizona, right? So for that company, that's a pretty good geographic distribution of resources for the point of a Zoom call.
Yeah, I've heard stories where, angels won't invest if they can't get to the board meeting within 20 minutes. And I'm thinking, maybe that's pre-COVID thinking, and at least I'm hopeful that that's the case. What, John's shaking his head no. You think they're still going to do?
In New York, 50% of the investments are outside of New York. In the Northwest, 94% of the investments are inside an hour of where they live. And so really fundamentally different worldviews, right? And so there are a lot of people that are still, I want to go have coffee, right? If you can't have coffee, then what's the point? And so I think that will persist in the Northwest a lot longer than it's going to persist in New York, right? So I think—
John, do you have COVID data for that? Like, has that changed in the last 24 months? How old is that stat?
The 94 stat is from 2019. I don't have more recent data, but I do know that several of the angel groups basically moved to hunker down mode instead of expand mode. So some of the angel groups are, this is where we're at and we're protecting our own, and some of them are, oh look, the door's open, let's go everywhere. Fundamentally different worldviews on the angel groups in town.
I'm going to draw us to a natural close here. Dave, great job taking us through some very complex things. We'll have this recording available on the YouTube channel, and I'll send it out to all the people who attended today, and you can always go and find our other talks. If you've got questions, you can always get to Dave, and we put his LinkedIn contact information in the chat box, and you can always save the chat in case you don't know by hitting those 3 buttons on the bottom right of where you type in, and that will save your chat. It will save it as a text, and then you just need to convert it to something else. Thank you very much, everybody, for joining us. Next week, we have Chris Salsilla and Steve Flom coming from, one's an NIH seed staff person, and the other is a entrepreneur in residence at NIH, as well as working with Techstars. And they are a great, it's important for you to come as investors and as companies. For founders, they'll tell what resources are available for you from the whole SBIR STTR program. But as investors, they'll talk to you about how they curate, develop, and showcase companies that are worth really having a look at.